Welcome to the Edified Equity Podcast. My name is Dino. Here we focus on all the unique benefits associated with being a passive equity investor in an apartment syndication. You can learn more about and follow us on the web, iTunes, Anchor, Facebook, YouTube, Twitter, LinkedIn, Instagram, and our award-winning blog on Bigger Pockets. All associated links will be in the show notes. If you find this information helpful, please subscribe, like, comment, rate, and review. Today, on episode number 81 of the Edified Equity Podcast, I have with us Yona, the cost seg king, and we have a really good program for you. Yona, before I even go into more detail, I just want to say welcome to the show.
Thank you so much, Dino. It is a pleasure. Waiting for this moment for so long.
I know, it's too long. I don't know what took us so long. We're probably both really busy with operating businesses.
Right. No, really, I do appreciate you having me on, and I'm happy to be here to share whatever knowledge we can share.
Yes, thanks so much. So Yona, also known as by many as the cost seg king, is a powerhouse with property owners tax savings. And that includes me. As a business director at Madison Specs, which is a national cost segregation leader, he has assisted clients in saving tens of millions of dollars on taxes through cost segregation. He has a background in teaching and a passion for real estate and helping others. Today, our goal is to go through a case study and with conversation, show you how and why you should utilize cost segregation and bonus depreciation. So having said that, Yona, if there's anything extra you want to add related to the intro, feel free. If not, go ahead and jump right into it.
I think you summed it up. That pretty much sums it up. Let's jump right into it.
Okay, perfect. So I asked him to go through a case study, because one of the things that I wanted to accomplish today is, and we'll get more into the tax portions in a second, but I really wanted him to show why it is I don't want to say it's a catch-all, but why for the most part, depending on the purchase price and what you plan, the business plan, what you plan to do, if you're buying a vintage property and you plan on doing a lot of value add, why for the most part it is a great idea to utilize bonus depreciation as well as cost segregation, and taking us through a case study, even to include some of the recapture that we hear talked about, but it's less understood, and that's the goal of the program.
Exactly. So we're not going to get right now into the nitty gritty of what is cost segregation, how it benefits you. I think we can get into that a little later maybe, or sure. You can definitely read up on that. But I appreciate the being able to provide some more detailed information into an actual case study. So let's say you invested into a syndication, right? Let's say you invested into a syndication through Edified Equities, right? In a real estate syndication where you are a limited partner. And as a limited partner, you own a share of the equity of that property. Or the entity that owns that property more exactly. Right. Let's say you own a 5% equity stake in the investment. Okay, so it was a $1 million property, and just to make things similar, $1 million raise of the equity, let's say, just to keep it simple, and you invested $50,000. So your stake is going to be $5,000. As a limited partner, you are going to have a share of the equity of that property and a share of the tax benefits that come along with that. The main tax benefit being depreciation, right? Depreciation is an income tax deduction based on the purchase price of the property, the day that you bought it, and then it's a portion of that. Every year for 27 and a half years, you get a small amount through cost segregation, bonus depreciation. We're going to front load a lot of that and get a lot more benefits in the earlier years. Okay, so over the first 5 years, we're going to identify personal property that is going to be a large percentage. You're going to get to take the depreciation on the personal property over the first 5 years. So again, as an investor, 5% of that you're going to get as a tax deduction, which will then be able to be used to offset the income produced from the property. Okay, so just to keep it simple, and I'll do a case study in a second so you actually see the numbers, but you just to keep it simple. Let's say your $50,000, right, got you a 10% return on your investment. Okay, so this calendar year, you made $5,000 from that. And you also received $5,000 of depreciation deduction from your 5% of ownership. So guess what? The $5,000 that you earned is now tax-free. The depreciation deduction has now offset that income, and the income that you're making from that property is totally sheltered from that real estate investment.
Right. So that is a great example. Thank you. So I think now what I'm thinking, and maybe I'm jumping ahead, but one of the things that I wanted to kind of get clear as the LP, if they are not a real estate professional, as the IRS would define one, is that deferred? Like, so you broke even, you made 5, but you wrote off 5, so it wasn't taxed this year. Later on, are they going to pay something, or is it truly deferred?
It's truly deferred.
I'm sorry, sheltered.
Sheltered, truly sheltered. The income that you made from this year's income is sheltered from that direct deduction.
Got it.
Even as an LP.
That's great. So real estate, I just want to get this clear because this is great info. Real estate professional or not, per the IRS's definition, it is sheltered completely. That 5,000, you made it, they wrote it off, you're taxed 0 forever.
Correct.
Got it.
Correct. That is a correct statement. From the income that you made, you are not taxed at all.
Okay.
If the depreciation, like our example, is equal or greater to the amount of income that you're getting from the properties. So where it's going to get a little more complicated, which I hope to break down in a simple form today, is when you're taking more depreciation deductions than you have income. Okay.
Yes.
And what's the difference between if I'm a real estate professional versus if I'm a LP, versus even if I'm an LP, but just happens to be an LP, a real estate professional, but an LP in this particular deal.
Right.
Okay. So that's really where it's going to get a little more complicated, but I think we're going to clear it up. Okay.
Yeah.
So I'm going to share my screen for a second. I think we're going to look at this case study. Is now the time for that, Dino?
Yeah. And I just want to throw in real quick, because someone might be wondering, like, so Dino, you are an active multifamily, like an independent deal sponsor, your firm is. Mm-hmm. Why would you be an LP in, let's pretend like Yona's deal? You have nothing to do with Yona except like, and trust him. You think he's a great operator. The reason is because a lot of active general partners have disqualified funds. So if I'm using, for example, a solo 401k and I have $250,000 in that solo 401k, even though I love my deals, obviously the government says you cannot use that money in your own deal. You can use it in someone else's deal, but you're going to be truly limited. You have no say so, you're not active. So that's why when you threw that in, I just wanted to make it clear that other operators invest in friends or people like I said earlier, they like, know, and trust. They believe in also not just them as operators, but they believe in the deal, the market, the whole 9 yards.
Absolutely. Absolutely. And that's an excellent point. I will take a little bit of a tangential, or maybe even just parenthetical on what you commented on the 401k money. That happens to be one of the scenarios where you're not even going to benefit from the depreciation, because the 401k money is not taxable, right? And so therefore it is not going to be able to benefit from the tax deductions that come from the depreciation from the properties. So that is another important thing to note. Yeah. There are, if from self-directed IRAs are taxable and can benefit to offset the taxes from there. 401ks or Roth IRAs are unique in that they are not taxable and therefore don't get the depreciation benefit from that. So that's a unique kind of aspect there.
Got it.
Okay, so let's get right into it. Should I pull up that screen and look at this
let's go
case
for it.
study? Okay, let me just click the slideshow button over here. And something's wrong with my mouse right now, but I am going to, there we go. And what did I just do now? Now I have to exit that. What did I do? Okay, let's exit that. What just happened? Okay, first I'm going to share the screen.
Okay.
We're not too technically okay, now everyone sees my screen. Okay, now we can start the slides.
Yes, perfect.
Perfect. Okay, we do this and then we do that. Perfect. Okay, so here we have a cost case study on cost segregation multifamily owners property. I'm just going to go back a slide just to give you a little bit of a story to, picture a story. This is actually a real property in North Carolina that was purchased by someone. It was a 32-unit garden-style apartment. As you can see in the pictures over here, if you are watching the YouTube or you're watching the video, if you're not, just imagine this in your mind. If you're listening to the podcast, beautiful, right? Landscaping, right? Beautiful asphalt. Actually, the asphalt's not so beautiful, but just picture that like it is. And you have, it was purchased for $1,750,000. So $1.75 million was the purchase price for this property. And again, the depreciation is determined by the purchase price. Doesn't matter if you bought this building highly discounted and the value, you got an appraisal and then the value is really $3 million. Your depreciation deduction is going to be based on that purchase price.
Okay.
The advantage of that, one advantage of that is that it doesn't matter if you put any money into the deal. Let's say you got a seller financed deal. That means you put zero of your own dollars, but the title went into your name. Therefore, it's your property. And the title in the closing was for $1.75 million and you didn't even put a single dollar. Or you got it financed and only put down 20%. Or you had a syndication and you only put in $50,000 and investors took the rest of the equity. The purchase price is still going to determine the depreciation for that entire property and the tax benefits that come with it. Doesn't matter who's paying for it. Okay, so this was his first multifamily property purchase after many single family residences. And the reason why I want to point this out is because there's actually a story behind this, that this particular gentleman had a failed 1031 exchange. So without getting too deep into what that is and how that works, basically a 1031 exchange is a way to defer capital gains tax when done properly through the sale of properties, real estate. This guy sold a large number of single family properties that he had in order to buy this building, and happened to be that, or he actually sold in the previous year and missed the opportunity to do the 1031 exchange. So he was hit with a very large capital gains tax.
Wow.
And then he met me. And then we learned about cost segregation, and he realized that through the cost segregation, what we were going to do was produce, and I'm getting ahead of myself a little just to give you the story, we were able to produce enough depreciation to actually offset the gains, the capital gains that he would have had to pay from the failed 1031. So depreciation does not only go to offset your income tax, but it can potentially also be used to offset capital gains tax as well. So there are a lot of advantages that are to this. And so this guy basically, he called me up on the phone crying, tears of joy, that he would not have to pay that six-figure tax bill that he was expecting.
Yeah, I bet.
Okay, so without cost segregation, the depreciation on this property would have been $54,086. And how we got to that number was by taking the purchase price, $1,750,000, and subtracting a certain value for land, because land itself does not depreciate. And so we subtracted 15% from that. What we were left over was about, well, let's do the math over there. Not a lot, right? About about $1 million and change, about $1,080,000. is what the depreciable basis was. So you divide that up by 56,000, 27 and a half years, and you're left with, about $1.5 million. Excuse me, not 1 million. $1.5 million was about what the purchase price, and you're divide that by 27 and a half years. Every single year, the depreciation deduction would be about $54,000. Now, if you're making money on this property, let's say you're making $54,000 of income, net operating income from the property. So the regular depreciation that you're getting would cover the entire income. And so again, it's equal. The depreciation is equal or greater to the income produced from the property. Your entire income is tax-free. Okay, and that's spread to the investors. He didn't come with any investors, happened to do this property on his own, but the same would apply if there were investors. Again, your portion of equity would give you that percentage of that depreciation that you could use. Now, it happened to be this was a very good income producing property. So he actually was making a lot more than $54,000 of net operating income from this property. He was making closer, to $100,000 of net operating income, which would leave about 50,000, that 54,000 that would get knocked off right away from regular straight depreciation, and another $50,000 that would be taxed at your tax rate, whatever your income tax rate would be. The income tax from the property is not different from your income tax rate. If a corporation owns the property, there may be different rates for that. But generally speaking, people own properties in an LLC, which is just a pass-through, and that goes directly to, based on your personal income tax rate. I did hear recently that there are certain countries in the world, and they don't have depreciation, but they have different, someone told me yesterday actually, that in Israel, a friend who owns properties in Israel, there's a tax rate of 10%, a flat 10% rate on income produced from rental properties. So that's something interesting to note.
Yeah.
There's not just a random trivia fact for you to know there, but getting back to our story, he was still left with about $50,000 exposed and would have been taxed. Okay. Right. What we did for him was the cost segregation. And just moving to the next slide over here, excuse me, you see, if you're watching the show, we did, subtracted 262,000 from the basis, which left us with about 1,488,000. We split that into three categories. Cost segregation segregates the costs. Okay, the engineers break out the building, that's the main structure, and in this case, it was about 72% of the property was allocated to the structural components, and that's not just the walls and roof and foundation, even things like main plumbing and main electric, all the value of those things, windows, doors are also structural. So all of the value of those assets and many more things come out to be 72%. So that's a little over $1 million was of the regular gets depreciated on the regular 27.5-year schedule. Okay, so $1 million. From that alone, he's getting about $30,000 a year just from that. But when we front load the 8% of 15-year land improvements, okay, which is all that beautiful landscaping we saw, okay, the pavement, the asphalt, the curbing, even stuff like if there's signage, if you have retaining walls or main drainage, sewage mains. So all that is considered 15-year assets and depreciated. All the value of those things depreciated on a 15-year schedule. That was 8% of the value of the property over $122,000. So divide 122,000, you're getting about, 122. I should have probably put this in the slide over here, but I didn't. So we're just going to do it manually. Divided by 15 is getting you an extra 8,000 or so of depreciation every year. So we're up to 38,000. All right, and then in the first 15 years. And then in the 5-year properties, 20%. Okay, and this is pretty typical for multifamily properties, somewhere between 15 and 25% for the 5-year assets. And the 5-year assets include all the stuff that's in the building is not part of the structure. So furniture, appliances, fixtures, carpeting, cabinets, countertops, all that stuff that has a lot of value to it. Over 20%, which we're talking close to $300,000 of depreciation that now we can take in the first 5 years. That's an extra $60,000. So altogether, we're getting in the first 5 years of ownership about $100,000 a year, as opposed to $54,000 a year.
Right.
Okay. And remember, his income on this property was about $100,000 a year.
Right.
So he's basically, through the consignation, paying a fee to do the service, which is about, somewhere between $4,000 and $6,000 generally for multifamily properties. Don't hold me to that, but that's what we charge, generally speaking, for these size multifamily properties. He was able to shelter income from this property for the next 5 years. Okay, $100,000 in your pocket, cash.
Yep, completely. Never going to be taxed on it. It's totally sheltered because of that.
Exactly. So what he actually opted to do, because of his situation with the capital gains, that he had missed through the failed 1031 exchange that he was expecting, he opted to take the 100% bonus depreciation, which is a new law that came into pass in the tax reform 2018, the 2017 Tax Cuts and Jobs Act, which allows you to opt. And again, this is only able to be done through a cost segregation study. It's an election that you can either calculate it the way we just described, allocating 5-year, 15-year to the property, or you can elect to take the entire 5 and 15-year depreciation in year number 1. So he decided to take $421,000 of depreciation in year number 1, which not only knocked off his $100,000 of income, so he's left with another $321,000 of extra depreciation. What's that going to go towards? That went to knock off his capital gains tax that he had. So he was left with no income tax from the properties, no capital gains tax, and he was a real estate professional, so he was able to use that to also offset his other active income and his spouse's income as well. So basically, he was left with not only income, $100,000 from the property, he was left with no capital gains tax from the failed 1031 exchange. He had other income, and his spouse had other income that was also sheltered through this extra depreciation in this year. And he was left with $100,000 of cash flow that he could now go ahead and reinvest into a new property.
Yeah. So this might be jumping ahead because I don't have all of your presentation. I don't have it memorized. But my question is, let's say he didn't have, because he's got the 421 and change thousand because of the bonus. Now, let's say between he missed the 1031 exchange, so he has to pay that tax. And let's say between him, because he's active, his other active, as well as his spouse's other active, let's say it wasn't all of that combined, it probably was, but all of that combined was under 421,000, and he has like 100,000 excess of a tax benefit. Does it roll over next year? What happens?
Great question. That any extra depreciation that is not used, regardless of the bonus depreciation or not, creates a passive loss, which means it goes into like this imaginary bank account in your tax return that doesn't go away. You don't lose it. It actually just carries forward. It goes to the next year and rolls over, and then you can use that next year. Now, there are limitations to what you can use that for next year and how you can use it. There are obviously rules how to use it. You have to use regular depreciation from that year's taxes first, right? And then you can dip into the passive loss. Excuse me. But yes, it does carry forward until either it runs out if you have excessive losses, which means basically all the income from the property is getting knocked off and you have excess, carries on until it runs out or until you sell the property. When you sell that property, the depreciation from that property that is in passive loss gets released. It means it gets released. It now can be, if there is anything left over, can now be used actually to offset income tax, the taxes from that year, the income tax from the property from that year, as well as potential capital gains tax as well, or what we're going to get into next, which is the depreciation recapture tax.
That's great. That's great. So essentially, it rolls over until it's used one way or another.
Exactly. And then if there is anything left over after that, after you sold the property, then it's lost.
Okay. But still, I mean, you would have had the benefits. You would still be very happy with the outcome.
Exactly. 100%. Okay. So yeah. So what shall we touch on the depreciation recapture tax next?
Yes, definitely. One thing, even before we do that, something you said, because I know listeners are probably wondering about this. There is so 4,000 to 6,000 is what you said, what you charge. But my question is, that's if someone actually went through with hiring you. It's not for, I don't know if I'm saying the right words, but for a quote. Is that right?
Correct. Yeah, we always provide an upfront, no-cost analysis of your property to show you what your potential tax benefits would be. Right. So that we do as a service. It's free, no cost, just educational purposes, so that you can understand. We provide like a chart, some charts, and a sample depreciation schedule. So you can compare what my straight line depreciation is and what it will be over the course of ownership versus if I did the cost segregation. What would it be in the first 5 years versus after that? It would be less depreciation, et cetera. So you see, so that we provide at no cost. Then, once you decide to engage us, we'll send an engineer to the property to take the report and then, produce the study.
Right. That's the real cost. I just wanted people to understand, because we have active operators that tune in as well. And anyway, I just want them to understand it doesn't cost $5,000 to get Yonah on the phone or even someone at Madison.
Maybe I'll start, but no, it's for the time being, it's free.
Okay.
That was sarcastic, in case you're just listening.
No. Right. No, I wanted to be clear, because there's formulas and things that they'll run. And like you said, they'll send you charts so you have a good idea. But then when it gets to the nitty gritty, they're going to send the expert out and say, okay, that was our best, in good faith quote. Here's what we find. It's we're right on the money. We're actually a little bit better, a little bit under, but nonetheless, they're going to give you probably a conservative ballpark of what you're looking at.
Correct. Yeah, we always aim to do conservative, and we'll actually undercut it always on the estimate, just so that we will outdo that no matter what on the actual study.
Great.
All right. So let's
go ahead and move on.
Let's move on. So just a little bit about, one of the main things that people hear when they hear about cost segregation, they hear, well, what about depreciation recapture?
Yes.
This is a very big, kind of like taboo amongst many people in the industry. They don't like to talk about it. And the truth is, one of the reasons why people may not want to talk about it is because there are so many factors that will come into play to determine what that will be.
Of course.
Okay. And I'm not going to actually give a whole course now on what that is and the 3 different buckets that depreciation recapture tax will fall into. That's probably a better conversation for, if you have a specific situation for your accountant, but I will describe what happens when you sell a property. Like we said, when the whole time that you're holding the property and you're benefiting from the depreciation deductions, if it's equal or more to the amount of income coming into you, then that money is tax free. Okay. So you're investing money tax free, which is definitely much better than, putting it in the stock market, any income that you're producing for anywhere else. Correct, Dino?
Correct. There's no doubt about it. In my experience, hands down, there is no better way. And of course, I wholeheartedly, looking at the numbers, it's just flat out evidence that the multifamily space, when it's done correctly and you utilize all the extra benefits and tap into the tax benefits, utilizing services like Yonah and Madison provide, there's just, I just don't see a better opportunity. And there's many ways to do it, but the need, the demand, the supply, everything you look at, it's all pointing in the direction that we have a very long runway ahead of us to supply, especially we specialize in the workforce housing space. We don't build we don't develop at all. We don't buy at luxury, and we stay away from, of course, the war zones as well.
So excellent. So I will, come in and say, even before we get into this topic, that don't get me wrong, the real benefactors for cost segregation specifically are going to be the real estate professionals, the active investors, because of one thing and one thing only, because they have a benefit that nobody else has, which is probably if you ask me, the craziest law in the entire tax code, which is that if you have extra depreciation above and beyond the income produced from your properties, which is passive income, you can now use those deductions to offset any of your active income, you or your spouse's W-2 income, your any other income. If you're a real estate, broker or a realtor, and you're making, large commission checks, you can literally use the depreciation to offset that and pay, sometimes little to no income tax whatsoever. And so they are truly the main benefactors with that regard. But, just getting back to, what we started with, and obviously to those who are listening who are more focused on the LP side, focused on the equity investors, you have a tremendous benefit as well, because like we described until, the income you're going to be getting during the course of ownership of that property is, for all intents and purposes, going to be tax-free. So that's, tremendous. But the but comes in, because when you sell a property, that's where things get a little tricky. Okay. So when you sell a property, you have what's called two taxes. One is called capital gains tax, which is if you sold that property at a profit, that profit that's called the gain, is going to be taxed at a certain rate. Sometimes it's 20, somewhere between 20 and 30%, depending on different factors on a federal level, on a state level, sometimes even in like New York City, in a city level, you'll get capital gains tax. So that's going to, and there can be a 1031 exchange that can defer that further on. Great. There's also something called depreciation recapture tax. Now, just to clear out a misconception that a lot of people, get, there's like, well, if you take depreciation when you sell, you just have to give it back. Wrong. You don't give back anything. Okay. What we do when a property is sold, you are now taxed on the amount of depreciation that was taken. So before we get into, what to do about that, let's just understand the mechanics of how that works. There's, like I mentioned before, there's 3 buckets of how the depreciation recapture is taxed at. But when you sell a property, the amount of depreciation is calculated over the course of ownership. And if you took cost segregation, you took a lot more depreciation, right? Because you not only took the straight line, depreciation, but you actually took, personal property. It's called the 1245. So it's actually taxed, a lot more because you've taken a lot more, correct?
Right.
Now, there's 2 ways to look at this. One way is, well, great. All the time that I, held this property, I made a lot of money. And all that was tax-free, and I reinvested that money, and et cetera, et cetera, et cetera. And now I sold it. I'm gonna get hit with the tax on that. Great. The other way to look at, and that's like, okay, I guess it's just the price to pay for making those returns. Okay, and that's a nice way of looking at it. But the other way of looking at it is, well, let's look at my entire tax picture and see what I can do to now mitigate that. To now go ahead and make sure, right? Because cost segregation is not just a strategy to, offset the income tax produced on the property, but it's actually a way, as we'll see shortly, to actually counter the depreciation recapture tax as well.
Great.
Okay.
Yeah. That's
okay.
Great.
Yeah. Because
just to be clear, we're talking about 2 different types of taxes. One is you invested as an equity partner, you have ownership, but you're limited, you're totally passive. But the operators put in the time, they waited for the right calendar date with the market, what they predicted would be the best, they had a great offer, they sold, you now made a profit, which you want. Don't get me wrong. I mean, look, the profit is always going to outweigh the, I don't know what the right word is, but having to pay the tax on it. Okay. And then the other tax is what you were talking about. You're going to get taxed on the amount of depreciation that you benefited from through having the investment. But I like how you said it. Nobody's taking anything back. You're just now paying the tax on the depreciation. That was totally sheltered, but the depreciation now benefit is going to have a tax.
Exactly.
Got it.
And again, now comes the cost segregation to see how we can actually combat the depreciation recapture tax, which is twofold. Number one, actually threefold. Okay, which the first one doesn't have to do necessarily with cost segregation, but if you were to do a 1031 exchange at the sale of a property, that not only defers the capital gains tax, but also defers the depreciation recapture tax.
Okay.
So that's number one. Okay, if you're in a syndication, it's not likely that it's going to be a 1031 scenario. They do exist. I've seen them. We work with them, right? There are tenant in common structures, TIC structures that can be done, but majority of the time it's not, okay? For many reasons we're not going to get into today. The second thing is that there's something called, which we before we get to that, the second thing is what we already mentioned before, which was that if you have an excess of depreciation through the bonus depreciation or through, just the excess of depreciation, and you have a passive loss, those passive losses get released, as we mentioned before, on the sale of the property, and now can be used to offset the gain and the depreciation recapture tax.
Okay.
So you have taken the depreciation, right? Which is crazy. You've taken that depreciation, it's created a loss, and then when you sell, it comes back and now can be used to offset the recapture tax. So it actually, taking that extra depreciation is actually a good thing.
Yeah.
So that's the second thing. The third thing is something that most people haven't even heard about. Accountants should know what this is, but it's something called partial asset disposition.
Okay.
Okay. This is something, right? Think about disposition means selling a property, right? Disposing of it. When you sell a property, you sell the entire property. But since you've already done a cost segregation, what you have told the IRS is, and this is according to their rules, that I have been depreciating my personal property over a 5-year schedule. And if you sell the property after having held it for 5 years, you have essentially used up that entire 5-year assets. And they basically, from a tax perspective, have little to no value left to them, which means you are not going to be taxed on the depreciation recapture on it because it no longer has value.
That is great. And that includes, so you, for example, I think you mentioned countertops were in there. And let's say you have, some of these apartment communities that I'm on the active ownership side on, we have tenants that is essentially, it is their home. They've been there 10, 20, 15 years. So if they're just taking care of it like their home, there's no reason a countertop can't last more than 5 years. So it's still being used.
Exactly.
But on paper, it has no value. Therefore, are you saying, they can't tax me on something that is zero value?
Correct. Well, exactly. They can't tax you on the depreciation recapture when I'm saying that there's no value left in it. So, and this is not something that you can just there's a special form to fill out.
Sure.
So it is something that, you want to definitely discuss with your accountant how to do this. It's a special form on the sale of a property called partial asset disposition. You can Google it if you want and find out a little more. So by doing that, what you're doing is that at least the 5-year property, the personal property that we front loaded and we took advantage of and took all those extra deductions from, if you've held the property for 5 years already, then you can basically allocate little to no value to that portion of the sale, right? And therefore, by telling the IRS that has no value, so the calculation is going to be less because of it.
Correct. Makes sense.
Yeah. However, if you held a property for less than 5 years, now what do you do? So, there are definitely strategies out there, and depending on how aggressive you want to get, you can do this partial asset disposition as well on that 5-year property, proportional, I guess you would say, to, how long you've held the property. So if you held it for 3 years, so you may just give a 60% or a 40% value or even a 20% value left to whatever that 5-year asset is. So either way, you're going to be getting less of that hit with that tax. There are even people who want to be as aggressive as, even after 1 year of holding a property, they will even take out very little value to that 5-year property. Now, again, that's aggressive strategy. There are people that do it. There are, very large accounting firms that do this for very large corporations in the United States, and they do this. So it is something that can be done. Should you do it? This is a conversation for your tax professional or the operator, whoever is going to be doing that.
Right. And where would they get that? I know there's a form you said that to fill out, but is that something that they're going to work with your company since you did the study, or through their accountant, their CPA?
It's going to be through the accountant. However, when, since we've done that, you have that broken out from the cost segregation. If you have not done a cost segregation study, so this doesn't even really apply to you.
Right.
So you're going to get the depreciation recapture tax on the amount of depreciation that was taken, because everything was lumped together in one big bucket.
Right.
And so you're just going to get hit with that tax at the sale.
Right. Yeah, I understand. Yeah, that makes a lot of sense. I mean, this was really good information. And so for that, and what we've been talking about is that's the limited partner. That's the equity owner's side. Has nothing to do, because like you said in the first example, with the 30, I think it was a 36, 32 unit, he was active, and we had talked about how it rolls over to offset the active income if he had any other business, and as well as his spouse. But in this case, we're talking about how that is not an option. However, here's how cost segregation not only helps you keep what you make while you're getting the distributions, also at the end to help offset some of the recapture. And we gave I think 3 or 4 different ways. One, we didn't dive too deep in, and I'll just mention with the 1031, it is very rare. It can be done, but for the most part, I know for our firm to accept a tenants in common, they pretty much have to come in with most or all of the equity through that 1031 exchange, and then we can talk and get them in on the TIC.
Right.
But other than that, if you say I needed, I sold a small portfolio of single families, I need 1031, 200,000. It just doesn't make sense.
Right.
On our end.
Right. Exactly.
Yeah.
Okay. So we've covered a tremendous amount of depth on this subject that I don't think I've ever really covered in this amount of depth on any other podcast. So we will definitely have to be spreading this far and wide.
We will. We will. I mean, one of the things that I'm good about is utilizing, different techniques to get bite-sized bits out, and it entices people when they hear you talking and the value that you're bringing. It will entice people to go and not only listen on the audio, which is syndicated across 8 platforms, but they will say, I really need, these guys are talking about slides, and obviously they have numbers and math. And I mean, I don't know about you, but when I'm driving, I could listen, but as far as I'm only so while driving. So it'll entice them to go back and I think watch it, use it as a reference almost, and say, let me make sure I understand that. And if not, they can reach out, because when we close out and we're going to let you give your contact info, they can reach out direct to the source and say, hey, I heard that was really good information. I just want to make sure I understand this. And it opens up that line of communication. But we will get it out everywhere and encourage people to listen. I have never, and I listen to podcasts, I've never heard anyone break it down this way. And for me, doing investor relations, and when we have everything that we do is private. We don't have any public offerings. So you don't hear about my offerings unless you know me, and we meet all the guidelines that the SEC requires. But what I'm getting at is I get these types of questions. And even in today's interview, I mean, I'm not you. I'm not the expert. I'm not a CPA. And I don't have a problem. There's no ego here. I have no problem saying that. But I have to be able to answer questions and then lead them to the true professional. Right. So this has helped. I'm even going to go back and listen to it and take some really good notes, because it was just a great episode. A ton of value here.
Amazing. Yeah, I really appreciate you bringing this out, because it was really your idea to touch on these subjects and these topics that we really are things that, that the investor, wants to know about. And even, the operators want to know about. I had a phone call with an operator this week who was a Madison Specs client, that we did a deal for him.
Mm-hmm.
And he actually had partnered with a client of mine. I'd never spoken to the first party. And he, they had partnered together. So we got on a conference call, the three of us.
Mm-hmm.
And the one guy said, we've used your company before. I really love it. And I have some questions, about the depreciation recapture and some other things and whatnot. We had a great conversation. And at the end, he's like, I've owned buildings for years. I'm an operator. I've used cost segregation every time. And these are things that I never knew. And, I really appreciate, the time you spent, just bringing this out. And so, that's what I love to do. Just, adding value, providing the information, and at least, if nothing else, just piquing the curiosity to, to ask more questions,
Mm-hmm.
And drill your accountant.
Exactly. Yes. Yeah. You have to help them help you, if you will.
Right.
And one thing, because we're going to close it out soon, but one thing we mentioned when we first started about the solo 401k and how you're like, well, that's not even taxed. So the cost segregation on that front is not going to help at all because they're not taxed anyway. Right. My question is, what about them when we talk about this, recapture and they made a profit? Does cost segregation help them there? No.
They're just out of that bucket. They're in like a different bubble in that,
right.
Their money.
Maybe we don't have time to cover it in detail. I'm just curious, are those people, because I know a lot of people are encouraged to do it that way because there's other taxes. Like you said, they're not taxed. There's taxes that I'm thinking of right now that like they can pretty much be sheltered from as well. But I'm wondering, so they're not taxed on the capital gain? I don't know. Maybe this is a whole nother episode.
Yeah, I think it is a whole nother episode. They're going to get taxed on the capital gain. The only thing that they're not going to benefit from is the depreciation, right?
Because they didn't benefit it, so they can't use those 3-4 buckets we talked about to also help. I see. They didn't benefit from it at all because they're not taxed.
Correct.
I got you. Okay, that makes sense. Well, speaking of closing it out and everything, I just want to reiterate, this was an awesome episode. We want to, keep it bite-sized and chunkable, although I think this is one people are going to go back and use as a reference. But we want to make sure they know how to get a hold of you. And also, he has something I've shared across my social, a really just phenomenal opportunity for some lucky person.
100%. Thank you, Dino.
Yes, you're welcome. So go ahead and share that information and tell us how we can get a hold of you before I close this out.
So the best way to find me is on LinkedIn. Believe it or not, check me out there. Very active, and hit me up. Connection, direct message. But if you want to email me and you maybe have more questions, or you have a property that you might want to get a free estimate on. My email is yweiss@madisonspecs.com. So the first letter of my first name, last name, WEISS @MadisonSpecs. And we, hope we can bring you more value in the future.
Definitely. And did you want to talk about the giveaway?
Yeah. Are we going live?
We're not going live, but we have a very fast 24, 48-hour turnaround.
Oh, so yeah, that's what I mean. So we actually have a giveaway. If you're listening to this right now, that is happening on December 19th. So the deadline to enter this raffle is December 18th, Wednesday, December 18th. So that if you're listening to this right now and you are holding before December 18th, 2019, okay, go find me on LinkedIn. We have a $5,000 giveaway. We're giving away a free cost segregation study or $5,000 towards a cost segregation study. All you have to do is enter the raffle, and the instructions are on the first line of my LinkedIn profile.
Mm-hmm. Yep, very easy. And if you're connected with me, you probably you can see me share. I've shared it as well. All right. Well, Yona, thanks again so much for coming on. It was a pleasure, and we'll definitely have this out in time for people to take part in your offering.
Thank you, Dino.
Yes, you're welcome. All right. Well, listeners, I hope you found this information helpful. And whether you're here for the education, like what we all experienced today, the entertainment, or if you or someone you know has a problem finding the right place to invest their money and they want education on a phenomenal alternative investment, please help them by sharing this information. I don't have anything to sell, but I am on a mission, and I will continue to deliver quality consultative content on a routine basis. Thanks for tuning in. Make it a great day. You certainly deserve it. This is Dino Pierce, CEO of Edified Equity, signing off. Goodbye.